This has got to be the Woodstock of capitalism.
Berkshire Hathaway holding its annual meeting in Omaha.
Wait to that all-important Berkshire Hathaway AGM.
It's one of the most cult events in finance, where in non-pandemic times, investors from around the world would go to Berkshire Hathaway's annual general meeting to hear probably the most famous investor of all time and his business partner, Charlie Munger, talk about developments over the year. Normally, this event has attendance of about 40,000 people, which for an AGM with just two guys talking is pretty unique. When I was watching it on Sunday morning, my partner came in and I said, "It's quite popular with finance guys." And she said, "Yeah, but finance guys aren't that popular." True. So just a bit of background for those who might not know, Berkshire Hathaway is an American multinational conglomerate run by CEO Warren Buffett, the so-called Oracle of Omaha.
News on the coronavirus. The very first day I bought stocks was March 12th, 1941.
Now, just before you dive into watching the 4+ hour meeting yourself, bear in mind that Warren Buffett is 90 and Charlie Munger is 97, so if you think this is going to be a high tempo affair, think again. I do think there are, however, some timeless takeaways which I'll be telling you about before the end of the video. Okay, so one of the key lessons is individual stocks are risky in the long run. So I discussed this in the video 4 harsh truths about owning stocks, that a small proportion of the market drive quite a high amount of the return, and also that today's winners might not be tomorrow's. Well, Buffett in the meeting shows a list of the 20 largest companies by market cap now and compares this to 20 largest companies by market cap about 30 years ago. And there is almost none, if not any, who are still in both lists. He says it's a great argument for index funds. The main thing is to be on board the ship. And what he means about that is that in an index fund, you capture the growth of the market, winners and losers, not just individual stocks. He also puts up a list of defunct automobile manufacturers, starting with the letters MA, and he just goes through the list, and these are all car manufacturers that went under. It's an incredible lesson. It's something which I've been trying to say, which is that individual stocks, there is a huge survivorship bias. We look back on the likes of Apple, Google and Amazon and we kind of think it was inevitable and that they would have always succeeded. But the truth is that's not right at all. If you don't diversify, you can be entirely right on getting the secular growth of an industry, but you can get your individual pick of those companies completely wrong. As Buffett says, there is a lot more to picking stocks than figuring out what's going to be a wonderful industry in the future. So the next point is just to beware the gamification of investing. So Buffett and Munger comment on things like Robinhood and where the market is right now. Buffett actually goes on for some time basically saying that, gambling's okay and we shouldn't shame it, but there is a real subtext to that, which is that ultimately it seems like he feels that a lot of people in the market are exhibiting gambling behaviours. It's become a very significant part of the casino group that has joined the stock market in the last year or year and a half. I can't help but agree with this. I think a lot of people who are trading in the markets now are a million miles away from Buffett's strategy. That's not necessarily a problem, it's just a very different strategy from someone whose favourite holding period is forever sort of mindset. So the next lesson is that Buffett got some stick for not buying the dip in 2020. So some of you might know, Buffett has been sitting on a huge pile of cash for a long period of time. So the big question put to him by one of the shareholders is that when the market dropped, why didn't he step up?
Insisting you had your elephant gun ready. The March 2020 listed equity sell-off came with promises from the U.S. government that they would do what it takes, yet you sat on your hands. Please help me understand what I missed.
So Buffett kind of reflects on this, and he mentioned that before the Fed stepped up in March 2020 to basically secure the markets, there was actually a run on money market funds at the time, just as we saw in the last financial crisis. Buffett praised Powell for his quick actions, and I think this is an interesting point to reflect on because it probably goes to say that central bankers are going to be treating financial crisis in a very different way to than they did, for example, in the Great Depression. And you could speculate and say that the whatever it takes mentality at a point of a financial crisis is potentially going to become the norm. Now, obviously, we don't know, but it's just an interesting point that is kind of between the subtext of what Buffett was saying here. I think it's important to recognise that Berkshire Hathaway has a large insurance-related business, and that is going to clearly take a large hit in the COVID crisis. So I can kind of understand his reticence there. So his next point is that Buffett would recommend buying the S&P 500 over Berkshire Hathaway. And this is actually referring to the fact that his estate is going to be invested in an S&P 500 index fund or tracker. So he is quite literally putting his money where his mouth is, albeit through his estate. This has been well publicised about Buffett, and he'll be leaving money for charities, but also money to his spouse in an index fund. And the main statement he mentions is, I do not think the average person can pick stocks. And the other points that Buffett does not think big tech is overvalued. Now, I should caveat, he doesn't say that he knows the other businesses in big tech, but I think this is more reflecting on the fact that Buffett has a very large holding in Apple through Berkshire Hathaway. And he basically says that interest rates are to valuations what gravity is to matter, remarking on the fact that we're in such a low interest rate environment right now, it fundamentally affects what we expect valuations to be. He also spends a while going through an economics book from the 1970s, basically saying that our current economic environment was almost inconceivable compared to historic standards. So the one that probably got the most headlines, Charlie Munger does not like crypto. So Buffett, quite funny, dodges the answer to the question on crypto, which I thought was quite charming. But Charlie Munger said this.
I think I should say modestly that I think the whole damn development is disgusting and contrary to the interests of civilization.
I've got to say, it is pretty funny, and maybe not a huge surprise. Him saying, I think the whole damn development is disgusting in contrast to the interests of civilization, might be a bit strong. And look, it remains one of the most controversial areas of finance. Okay, another thing is Buffett says he thinks market sentiment is making it harder to find deals. So there's a conversation about SPACs, and Buffett says that due to private equity deals and things like that, the basic sentiment is that there is a lot of institutional money chasing deals at the moment, which is making it much harder for Buffett compared to historic standards to find the kind of deals he wants. Which I thought was an interesting statement on market comment. So the timeless takeaway is, being into stocks is the key to an eternal life. And I joke, but Charlie Munger is 97 and Warren Buffett is 90, and they've got no signs of slowing down at the moment. I guess we can take something from that. Thanks very much for watching Principal's Personal Finance, for the questionable content, but mainly, as I mentioned, the chance that you might be able to secure eternal life. I really appreciate you watching. I'll see you next week.